What's up, people? So this is the financials for Tropical Battery. Yes, essentially Tropical Battery is really just an energy storage company per se. They sell batteries. In addition to that, they also sell tires, solar energy products, as well as things that help your car to function properly, such as coolant, uh, among other stuff. If you not yet watched the video, then I would suggest watch the video before what this video before you actually watch the financials. You get a better understanding of it. However, this is financials. I don't want really hold you guys too long, so yeah.
Hello, people. So this is the financials for Tropical Battery, and I must say, going forward, my financial statements might start looking a little bit different. I'm currently going school again. That's why I've been missing for a minute. Wait, so the financials will be looking a little bit different. I guess better per se. I'll start doing predictions and like stress testing and valuation when we reach that bridge, we cross it though. But I'll try to keep some of the elements so that it looks familiar the same way. But yeah, anyways, so we'll just jump right into it. Predominantly, we're going to be talking about the financial statements. Not really much there, honestly. Relative valuation, dividend, and price action. In addition to the fact that we're going, DuPont and the ratios. So we'll just jump right into it and don't waste any of our time. Alright, so as relates to revenue, it has been relatively stable for the most part, really. And I just pulled their 5 year the 5 year statement that they had in the 2023 uh paper. So it's been relatively stable. There's not much to really say. Granted, in 2022 there had to be a jump as relates to revenue, but also that everything has been relatively stable. Alright, but going to the ratios, 'cause I think maybe that's where you can tell a little bit more story about the company. So current ratio, really, as you know, is current assets over current liabilities, and the current asset can cover their current liabilities 2.33 times, almost 1.5 times, right? And if you minus inventory, which is all the batteries and something they have, they still can cover it more than one time, which is good. Yeah, the ideal number is over one, so anything over one is really good as relates to the type of business they are, which is really retail and distribution, because they buy and sell back. These ratios that relates to efficiency and profitability may be the bigger impacts for them, or at least these are what we probably focus on per se. So the turnover ratio has been getting better based on what I'm seeing, meaning that you're able to sell more stuff, right? Uh, in the sense that, well, you can understand that they have been actually expanding, so they have more point of contact to get more customers, so that is also better. As it relates to number days which inventory is tied up has been getting less, which essentially would correlate with the turnover ratio, because if you're selling more, you're going to have less, like say batteries or the oils or the tires. You'll have on unlike just sitting down in the store. So that kind of correlates really. Collection period now, they have been getting better as well. As I said, they have more direct points of sale where they can, collect their money. Granted, they have retailers that they have authorized dealers, but as relates is moving from 75, meaning little bit over 2 months, then take to collect back the money. So normally I'm assuming, based on the business model, is they would send out the batteries and the different products that they have, and then once it is sold, then they'll collect back the money. So it's moving from that process being about a little bit over 2 years to where now it's well, like a month and a half now, basically, in the grand scheme of things. And in the return, the average, I guess they are turnover, uh, really is how much time per year they're collecting the debt that is outstanding from the outstanding customers, which these would correlate with each other as well. So as you can see, it would have been like 4.82 times they would collect their money over the course of a year, all the way now to 7.7, basically almost doubling it in the course of 5 years, which is good. They're getting better and better, meaning that that money can now be used to buy other stuff and etc. 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 But the part I personally don't like, but it is what it is as it relates to these companies that are in the distribution and retail, is their ratios as it relates to profitability. Their gross profit is about 30% of their revenue, meaning what it costs to actually sell the product at that point, I guess, is about 30% is their they hold on to. But then after that, after them pay all them administrative expenses and such, you can see that it is not really that great. But it's just me, I like the big numbers. But we just have to understand it's just the industry that they're in. So yeah. So about give or take 10% of gross profit is what they're normally making, basically. So that they have as bottom line. And I guess maybe that's why. Well, this is depends. As it is the coverage ratio, you really want the coverage ratio as high as possible. However, they have acquired new companies and other expenses per se. So I kind of understand the fall off, but they've been drastically acquiring companies. So their coverage ratio, as in like what their cash reserve can cover, going below. Because let's say you had, for example, one building and you're paying $10 on that building per month, and you had $100, mean that your cash reserve could have covered that building 10 times. But now you have five new buildings and you're paying $10 each, which is $50. So now you really only can cover those expenses twice. The only good thing is going forward, those said companies will start generating more and more revenue for them, which will then supplement back the whole cash reserve that they have. Will it be back to 2020 to 2019 numbers? Not sure, but I guess just give it some time in the grand scheme of things. And when you look at them, the point analysis, which was the only thing I did, because I guess that's the only visual representation that can show you something. You can see based on the numbers alone that they're relatively stable. And I guess maybe that's why they want to jump to the main market, because main market companies are relatively considered stable companies in the sense that everything is relatively predictable. There's not no major growth factor. I think they have maybe reached where they want. So I understand. Because when you look at this, as you can see, um it's basically flatline. Flatline, not dead, but flatline in the sense that it's flat for the most part. There is no real big jumper other than maybe the leverage, which, as I said, they've been acquiring companies and in something there, so it going to increase. But outside of that, everything has been linear. As you can see, the return on equity has been, it's actually kind of dipping a little bit, and return on assets also has been dipping. But we're giving them time because most of these stocks are like a year or two now, so we're giving them time to see what is what. But I understand the jump for it, because then I did put it as I say in the factor growth, because I am banking on the fact that these acquisitions will prove vital. Uh, but yeah, we will see what happens. So now to the relative valuation. So relative valuation, these are all the companies that would be within the retail space in the junior market. It's quite a few, 13 companies total. Uh, but yeah, so of these companies, the relative valuation for it, when I checked, the price was at $2.86. Uh, the relative valuation for it is about $3.94 or 95 cents, almost $4. But it's not there. So means it actually currently discounted at about 38%, which is good. And I say it can grow into said number, but we'll just have to see what happens. And of course, guys, please don't this is financial advice. It's just me going through the numbers and telling what the numbers is as relates to this. So there is that. As relates to dividend, because based on these figures that them have, these let me just show you up. These 2% at them figures here, which would translate into about, let's see, total comprehensive income, about 50 mil, give or take. 50 mil all the way up to 95 mil. So 50 mil to 95 million dollars, they can't really pay much dividend. So you're not going to expect this to be a dividend company. But yeah, as you can see, the dividend payout when I did the I checked the prices based on the close dates and when them actually paid dividend, it was basically less than 1% in 2021. In 2022 was a little bit better at 1.56%, and at 2023 it was 1.65%. Alright, so based on dividend, you might see that it's kind of, not the greatest, honestly, but you've also seen that the stock price has been raising. Alright, and we actually pull the price action to like kind of see what was actually going on. But when you think about it, the price has technically doubled since the payout of the 2 cents. I guess the payout of the 2 cents that they had paid out, the price was at $1.29, which if you really want to visualize it, see if we can really want to visualize it, it would be about here, so down here, so it would be all right, and then they doubled it the following year, which is the payout to match the price that is currently that it was at in 2023, which was $2.42, which would be about here, so around this part, $2.57, around here, so around that P here. So you can see it's a big jump and they double the payout. So if your projection is accurate, if let's say you have had like them shares from even 2021, you'll actually getting about, let's say now, 2 4 ish 5 ish 6 ish percent um in dividend payout. But yeah, there's that. Anyways, but that is really the thing. They have been doubling it, so you can probably either project that either they're going to add two, which are going to pay 6 cents 2024, or they're going to pay maybe 8 cents, seeing that they're doubling. However, the stock price at 242 up to this year hasn't really significantly changed, because the closing price uh up to January 31st was $2.70 something. So it either might stay at the around 4 cents per hour mark or go up a little bit. But we just have to see what they do because it's kind of hard to predict what they're doing, honestly. Um, but the the trajectory is upwards from 2022. It's upwards, same way it did a dip, say upwards. So I'm expecting with a little forex background, either it going come to around the 260 at mark, then bounce and go up, or it going kind of flat out at this area because it's right there, but basically no. So give like maybe a month or two to see what it goes. So if it maybe go here, so then you might be able to say, all right, maybe it either bounce down or it bounce to here. So this price of about $3, then either consolidate a little bit and then go up or go back down to here. So and then would go up. But it's just something I have to just wait and see. But yeah. As I said, this was a very short video. There wasn't anything crazy about it. I already spoken about their acquisitions. I giving it some time for it to develop, especially these renewable energy things that currently the US has, been doing some stuff. So just gonna have to wait and see what happens. And yeah, thank you guys for watching. Next video going to be coming out very very faster because as I say, I'm going to school. I've learned some faster way to sift through numbers. Uh, One of the great areas for me was actually pulling the financials per se. Fun faster way. So yeah. Also, guys, if you actually want to be a lazy investor, uh, you can download the My Money JA app and you can use my discount of guard guard 876 put on screen, and you can get a little discount and you can get all these information really at your fingertip rather than sitting down and going through all these numbers or you waiting on me per se. So yeah, of course, love you guys catching this video. uh Peace. All right.